Understanding financial statements. A snapshot of a company's financial performance. Statements. Financial statements are essential documents that provide a snapshot of a company's financial performance and position over a specific period. They are crucial for understanding the company's profitability, financial health, and overall business operations. The main financial statements are income statement, profit and loss statement. The income statement shows a company's revenues, expenses, and resulting net income or loss for a specific period, typically a quarter or a year. It follows the generally accepted accounting principles GAAP and includes both cash and non-cash expenses, such as depreciation. This statement helps stakeholders understand how much money the company earned and spent during the period and how much profit or loss it made. It is vital for investors and creditors to assess a company's profitability and sustainability. Balance sheet statement of financial position. Balance sheet statement of financial position. The balance sheet presents the company's assets, liabilities, and shareholders' equity at a specific point in time. It follows the basic accounting equation: assets equals liabilities plus shareholders' equity. The statement is categorized into two main parts: the left side assets and the right side liabilities and shareholders' equity working capital, which is the difference between current assets and current liabilities, is also included in the balance sheet. The balance sheet is essential for understanding a company's financial position and its ability to meet its obligations and fund its operations. Cash flow statement. Cash flow statement. The cash flow statement reports the inflows and outflows of cash and cash equivalents during a specific period, categorized into three main sections. Cash flow from operating activities CFO shows cash generated from the core business operations like sales and expenses. Cash flow from investing activities CFI reflects cash used for investing in assets, acquisitions, or proceeds from the sale of assets. Cash flow from financing activities CFF presents cash transactions with investors and creditors, such as issuing stock, taking loans, or paying dividends. The cash flow statement is crucial because it provides insights into a company's ability to generate and manage cash, which is vital for its day-to-day operations, expansion, and debt servicing. Financial documents. Financial statements are vital financial documents that provide a comprehensive view of a company's financial performance and position over a specific period. They are essential for investors, creditors, and other stakeholders to assess the company's financial health and make informed decisions. The four main financial statements that a large company is required to provide are: Statement of Owner's Equity, Statement of Changes in Equity. Statement of Owner's Equity, Statement of Changes in Equity. This statement shows changes in the shareholders' equity during a specific period. It typically includes items like net income from the income statement, contributions from shareholders, dividends, and any other adjustments to equity accounts. The statement of owner's equity is important for understanding how a company's equity position changes over time and what factors contribute to those changes. In simple terms, financial statements are like a report card for a company. They summarize its financial health, performance, and overall standing. They help investors, creditors, and other stakeholders make informed decisions about whether to invest in or lend to the company. By analyzing these statements, stakeholders can assess a company's profitability, liquidity, solvency, and potential for growth. Additionally, financial statements are crucial for compliance with accounting standards and regulations, ensuring transparency and accountability in the business world. Balance sheet statement of financial position. The balance sheet provides a snapshot of the company's financial position at a specific point in time. It presents the company's assets, liabilities, and shareholders' equity. The equation assets equals liabilities plus shareholders' equity highlights that the company's resources assets are either funded through debt liabilities or shareholders' investments equity. This statement helps answer the question: what does the company own, and how much is left for shareholders? The balance sheet is crucial for assessing the company's liquidity, solvency, and overall financial stability. Cash flow statement. The cash flow statement outlines the inflows and outflows of cash and cash equivalents during a particular period. It consists of three main sections: cash flow from operating activities CFO, cash flow from investing activities CFI, and cash flow from financing activities CFF. The statement helps answer the question: where is the company getting its cash and how is it using it? By understanding the cash flow patterns, investors and creditors can evaluate the company's ability to generate cash, handle debts, and fund its operations. Statement of owner's equity, statement of changes in equity. The statement of owner's equity shows changes in the shareholder's equity over a specific period. It illustrates the impact of net income, additional investments by shareholders, dividends paid, and any other adjustments that affect equity. This statement helps answer the question, how much has the shareholder's stake in the company changed over time? It is valuable for understanding how the company's profits are reinvested or distributed to shareholders. In summary, financial statements are crucial tools for assessing a company's financial health, performance, and stability. They provide valuable insights into its profitability, liquidity, cash flow management, and equity changes. Investors use these statements to decide whether to invest in the company, while creditors evaluate the company's creditworthiness. Moreover, financial statements promote transparency and accountability, ensuring that companies comply with accounting standards and regulations, while disclosing accurate and relevant financial information to stakeholders. Income statement. Income statement. Think of the income statement like a report card for a company's profits. It shows how much money the company made revenue and how much it spent expenses during a specific time, like a year or a quarter. The difference between the revenue and expenses gives you the net income or net loss. Why is it important? The income statement tells us if the company is making money or not. Investors use this to see if the company is doing well financially and if it's worth investing in. Example, imagine you start a lemonade stand. You sell lemonade for $50, but it costs you $20 for lemons, sugar, and cups. Your net income on the income statement would be $50. $20 equals $30. That means you made $30 in profit. Balance sheet. Balance sheet. The balance sheet is like a snapshot of what a company owns and owes at a specific moment. It's like a company's financial snapshot. On one side, you know how the company owns assets, and on the other side, you have how the company paid for those things, liabilities, and equity. Why is it important? The balance sheet shows the company's financial health and how well it can handle its debts. It's like checking the company's bank account and debts at a particular time. Example, imagine you have $100 your assets in your piggy bank, and you owe $20 to your friend your liabilities. Your equity would be $100. $20 equals $80, which is what you actually own. Cash flow statement. This one is like a record of all the money that comes into and goes out of the company. It's like tracking the flow of cash in and out of the business. The statement divides the cash flow into 3 categories: cash from daily business activities, cash from buying and selling things, and cash from financing, borrowing money, or getting investments. Why is it important? The cash flow statement shows if the company has enough money to pay its bills and grow. It helps to see if the company is managing its money well. Example, imagine you earned $200 from your lemonade sales operating activities. You spent $50 on new cups and lemons investing activities, and you borrowed $30 from your mom to buy more supplies financing activities. Your net cash flow would be $200. $50 plus $30 equals $180, which means you have more cash on hand. In a nutshell, financial statements are crucial because they provide essential information about a company's performance, financial health, and how it manages money. They help investors, creditors, and other stakeholders understand the company's potential and make better decisions. Just like how a report card tells you how well you're doing in school, financial statements tell you how well a company is doing in its business. The income statement. The income statement is like a financial report card for a company. It shows all the money the company earned, revenue, and all the costs and expenses it had to pay during a specific period, like a month or a year. The expenses include things like the cost of producing goods, employee salaries, rent, and taxes. Now, here's the cool part. When you subtract all the expenses from the revenue, you get what's called the net income. This is also known as the bottom line, because it's the final result after taking everything into account. Why is it important? Well, the income statement tells us how well the company is doing in terms of making money. If the net income is positive, it means the company made a profit. But if the net income is negative, it means the company had a loss. Key components of the income statement. Let's break down the key components of the income statement in simple terms. Revenue. This is the total money a company makes by selling its products or providing services. It's like adding up all the money they earn from their customers. Cost of goods sold, COGS. This is the cost of making or buying the products the company sells. It includes things like raw materials, labor, and other expenses directly related to producing the goods. Gross profit. This is what's left after subtracting the cost of goods sold from the revenue. It shows how much money the company made from selling its products before considering other expenses. Operating expense. These are the day-to-day expenses that a company incurs to run its business. It includes salaries of employees, rent for offices or stores, utilities, and other costs needed to keep the company running. Key components of the income statement. Depreciation/amortization expense. This is a bit tricky, but in simple terms, it's an accounting way to show the decrease in value of certain assets, like machinery or equipment over time. It's not an actual cash expense, but it helps to account for the wear and tear of these assets. Earnings before interest and taxes, EBIT. This is what's left after subtracting the operating expenses, including depreciation/amortization from the gross profit. EBIT shows how much money the company made from its main operations before considering interest on loans and taxes. Interest expense. This is the money the company pays as interest on loans or debt it has taken. It's like paying rent on borrowed money. Key components of the income statement. Earnings before taxes, EBT. This is the amount left after subtracting the interest expense from the EBIT. It shows how much money the company made before paying taxes to the government. Taxes. This is the money the company pays to the government as taxes on its profits. Net income. This is the final result, also known as the bottom line. It's what's left after subtracting the taxes from the earnings before taxes, EBT. Net income shows how much money the company made after paying all its expenses, including taxes. Why are they important? The income statement is crucial because it gives us a clear picture of a company's profitability. It shows how much money the company made, what it spent to make that money, and how much profit is left in the end. It helps investors and stakeholders understand how well the company is performing and whether it's making enough profit to cover its expenses and grow. For example, think of a lemonade stand again. If they made $100 by selling lemonade revenue, but had to spend $40 on lemons, cups, and sugar co-Gs, and $30 on salaries and rent operating expenses, they'd have a gross profit of $100. $40 equals $60. After considering other expenses like depreciation and interest, let's say they have a net income of $20. That means they made $20 in profit at the end. So the income statement is like a financial story that tells us how much money a company made, how much it spent, and how much profit it earned. It's important because it helps us evaluate the company's financial health and make informed decisions about investing in or supporting the business. GAAP is like a set of rules or guidelines that accountants use to make sure they record financial transactions consistently and accurately. It's like having a standard playbook that everyone follows to keep things fair and understandable. These principles help companies create their financial statements in a way that's reliable and comparable to other companies. Why is it important? GAAP ensures that financial information is consistent and trustworthy. Investors, creditors, and other stakeholders can rely on the financial statements to make informed decisions about the company's performance and financial health. Matching principle. The matching principle is like making sure expenses and revenues are paired up correctly. It means that expenses should be recorded in the same period when the related revenue is earned. This way, the costs of doing business are matched with the income they help generate. Why is it important? The matching principle helps create a more accurate picture of a company's profitability. It shows the real cost of earning revenue and gives a better understanding of how much money the company is making. Example, if you run a lemonade stand and sell lemonade on Monday, the cost of the lemons, sugar, and cups used to make that lemonade should be recorded on Monday as well. This way, you can see how much it really costs to make the lemonade and how much profit you made from selling it. Fair market value. Fair market value. Fair market value is like an educated guess of how much something is worth, based on what a willing buyer would reasonably pay for it. It's like finding out the fair price of something in the market. Why is it important? Fair market value helps companies value their assets like buildings, equipment, or inventory more accurately. It's important for financial reporting and also when companies want to buy or sell things. Example, imagine you have a used bike. Fair market value would be how much someone would be willing to pay for that bike if you sold it today. It might not be the same as what you originally paid for it, as it takes into account factors like age, condition, and market demand. Revenue recognition. Revenue recognition means recording revenue when it's earned and can be reasonably expected to be collected, not necessarily when the money is received. It's like counting the money you will get from a sale once you've done everything required to earn it. Why is it important? Revenue recognition makes sure that revenue is recorded in the correct accounting period. This way, the financial statements show the true picture of how much money the company earned during that specific time. Example, If you have a bakery and you sell a cake to a customer who will pay later, you would recognize the revenue on the day you sold the cake, even if you haven't received the money yet. This is because you've done your part of the deal and earned the money. In summary, these accounting principles are essential for maintaining consistency and accuracy in financial reporting. They help ensure that financial statements provide a true and fair representation of a company's financial performance and position. Following these principles gives stakeholders confidence in the reliability of the financial information, which is crucial for making informed decisions about investing, lending, or doing business with a company. Non-cash expenses. Non-cash expenses are expenses that a company records on its financial statements, but they don't actually involve writing a check or spending money. It's like having an expense on paper, but no actual cash goes out of the company's bank account. Here are the three most common non-cash expenses. Depreciation. Depreciation is a way to account for the wear and tear of physical assets, like machinery, equipment, or buildings that a company owns. Over time, these assets lose value due to usage, age, and obsolescence. So instead of recording the full cost of these assets as an expense in one go, accountants spread the cost over their useful lives. Why is it important? Depreciation helps to match the cost of using these assets with the revenue they generate. It gives a more accurate picture of a company's profitability by showing the gradual decrease in the value of its assets over time. Example: imagine you buy a delivery van for your business. It costs $50,000 and its useful life is estimated to be 5 years. Instead of recording $50,000 as an expense in the first year, you would record $10,000 as depreciation expense each year for 5 years. This way, the financial statements show the real cost of using the van for business operations. Amortization is similar to depreciation, but it applies to intangible assets like patents, trademarks, or goodwill. Intangible assets don't have physical substance, but they have value because they provide some advantage to the company. Why is it important? Amortization helps account for the use of intangible assets over time, just like depreciation does for physical assets. It spreads out the cost of these assets on the financial statements, giving a more accurate view of the company's financial health. Example: let's say your company bought a patent for a new technology. The patent cost $100,000 and its useful life is estimated to be 10 years. You would record $10,000 as amortization expense each year for 10 years to reflect the gradual use of the patent's value. Obsolescence happens when an asset, whether it's inventory goods held for sale or a fixed asset like machinery, becomes unproductive or outdated due to various reasons. It could be spoilage, breakage, technological advancements, or changes in customer preferences. Why is it important? Recognizing obsolescence as an expense helps prevent overstating the value of assets on the financial statements. It shows that some assets have lost their value or are no longer useful for generating revenue. Example: imagine you have a retail store with electronic gadgets, and some of the gadgets have become outdated because newer models are now available in the market. You need to recognize the obsolescence of these outdated gadgets as an expense, even if you haven't sold them yet. In summary, non-cash expenses, like depreciation, amortization, and obsolescence, are essential for accurately representing a company's financial performance and the true cost of doing business. They help match expenses with the revenue they generate and prevent overvaluing assets, providing stakeholders with a more realistic view of the company's profitability and financial health. The balance sheet is like a financial snapshot of a company at a specific moment. It lists everything the company owns assets and everything it owes liabilities and owner's equity at that particular time. Think of it like checking the company's financial health at a specific point in time, just like checking your own bank account balance. Assets are things the company owns or uses to make money. It includes physical things like buildings, machinery, and inventoried products ready to be sold. It also includes non-physical things like money in the bank cash, money owed to the company accounts receivable, and intellectual property patents or trademarks. Liabilities are the ways the company uses to pay for its assets. It includes things like loans, debts, and money owed to suppliers or other parties. These are the company's obligations to pay back what it borrowed or to settle any debts. Owner's equity is like the company's savings or net worth. It's the amount left over when you subtract all the liabilities from the assets. It includes the money invested by the owners like shareholders and the company's accumulated profits over time. Now, here's the fascinating part. The balance sheet always balances. The name says it all. This means that the total value of assets should always be equal to the total value of liabilities plus owner's equity. It's like a mathematical equation. Assets equals liabilities plus owner's equity. Why is the balance sheet important? Financial health check. The balance sheet helps us understand how well the company is doing financially at a specific moment. It shows if the company has more assets than liabilities, which means it has a positive net worth or equity. Liquidity and solvency. By looking at the assets and liabilities, we can see if the company has enough cash or assets that can quickly be turned into cash to cover its debts and obligations. It helps us gauge the company's ability to pay its bills. Decision-making. Investors, creditors, and other stakeholders use the balance sheet to make informed decisions about the company. It helps them assess the company's financial stability, growth potential, and creditworthiness. In a balance sheet, we have two main sections: assets and liabilities plus owner's equity. Assets. Assets are things a company owns or uses to make money. It includes physical things like buildings, equipment, and inventory, as well as non-physical things like cash in the bank or money owed to the company. Liabilities plus owner's equity. Liabilities are the ways a company uses to pay for its assets. It includes things like loans, debts, and money owed to suppliers or other parties. Owner's equity, on the other hand, represents the amount of money invested by the owners like shareholders in the company, plus any accumulated profits the company has earned over time. Now, here's the super important equation. Total assets equals total liabilities plus owner's equity. This equation always has to hold true. The total value of all the assets a company has must be equal to the total value of all its liabilities and owner's equity combined. Why is this equation so crucial? Balancing act. The balance sheet equation ensures that a company's finances are in balance. It shows that every dollar of assets the company owns is funded either through liabilities, debts, or owner's equity investments, or retained earnings. Accuracy check. The equation serves as a double check to make sure all the financial information is recorded correctly. If there's a mistake in the balance sheet, the equation won't balance, alerting accountants to look for errors. Financial health. By looking at the balance sheet equation, we can quickly assess the company's financial health. If the assets exceed the liabilities and owner's equity, the company has positive net worth and is in good financial standing. The value of your lemonade stand: all the lemons, sugar, cups, and cash you have is your total assets. Now, let's say you borrowed $30 from your parents' liabilities and invested $50 of your own money owner's equity to start the lemonade stand. The balance sheet equation for your lemonade stand would be total assets equals $100 total liabilities plus owner's equity equals $30 plus $50 equals $80. The equation doesn't balance. This means there might be a mistake or something missing in your records. You would need to go back and check your numbers to fix the balance. In summary, the balance sheet equation is the heart of the balance sheet. It ensures that the financial statements accurately reflect the company's financial position, and it helps investors and stakeholders understand the company's financial health and stability. Let's break down the important parts of the balance sheet in simple terms. Assets, current assets. These are things a company owns that can be quickly turned into cash within 1 year. They are like the quick assets that can help the company meet its short-term needs. Cash. This is the actual money the company has in the bank or as physical cash. Accounts receivable. This represents money owed to the company by customers who bought products on credit. It's like keeping track of the money customers owe you. Inventory. These are the goods or products the company has in stock to sell to customers. Fixed assets. These are things the company owns that are not easily converted to cash, but are essential for running the business. Gross fixed assets. This is the total value of all fixed assets, such as machinery, equipment, and buildings, less accumulated depreciation. Depreciation is a way to account for the decrease in value of fixed assets over time due to wear and tear. Subtracting accumulated depreciation from gross fixed assets gives us the net fixed assets value. Current liabilities. These are debts or obligations the company needs to pay off within 1 year. They represent the company's short-term financial obligations. Accounts payable. This includes the money the company owes to suppliers or vendors for goods or services received but not yet paid. Accruals. These are financial obligations related to payroll, employee salaries, and taxes that are not yet paid. Notes payables. These are short-term debts that the company owes and needs to pay back within a year. Long-term debt. Unlike current liabilities, long-term debt is the money the company owes that will take more than 1 year to pay off. It's like long-term borrowing. Common stock. This represents the ownership interest of shareholders in the company. When someone buys shares of a company, they become a part owner, and this is their ownership stake. Retained earnings. This is the accumulated profit the company has earned over time and has chosen to keep retained in the business rather than distributing it as dividends to shareholders. Why are these parts of the balance sheet important? Assessing financial health. Current assets and liabilities give insights into a company's short-term financial health and ability to meet its immediate obligations. Long-term stability. Fixed assets and long-term debt help understand the company's long-term financial stability and its capacity to grow and invest in the future. Ownership and earnings. Owner's equity shows how much of the company is owned by shareholders and how much profit the company has retained for future growth. Sheet equation is always crucial. Total assets equals total liabilities plus owner's equity. This equation ensures that the financial statements are balanced and accurate, providing a clear view of the company's financial position. Investors, creditors, and other stakeholders use the balance sheet to assess the company's overall health and make informed decisions about its future. Working capital is like a financial health check for a business. It tells us if a company has enough liquid assets to cover its short-term debts. Liquid means assets that can be easily turned into cash or used to pay off obligations within the next year. Current assets. These are assets that a company expects to convert into cash or use up within 1 year. They include things like cash in the bank, money owed by customers' accounts receivable, and inventoried products ready to be sold. Current liabilities. These are the company's short-term obligations or debts that need to be paid off within 1 year. They include things like payments to suppliers' accounts payable, payroll-related expenses accruals, and short-term loans notes payables. Now, let's calculate working capital using the formula. Working capital equals current assets, current liabilities. The result shows if the company has a positive or negative working capital. Positive working capital. If the result is positive, it means the company has enough current assets to cover its current liabilities. This is a good sign because it shows the company is in a strong financial position to meet its short-term obligations. Negative working capital. If the result is negative, it means the company doesn't have enough current assets to cover its current liabilities. This could be a red flag, indicating that the company might struggle to pay off its short-term debts. Financial health. Working capital helps us assess how well a company can manage its day-to-day operations and pay its bills on time. Positive working capital indicates a healthy financial position, while negative working capital may signal potential financial troubles. Cash flow management. Managing working capital is essential for ensuring the company has enough cash flow to handle its short-term financial needs. By efficiently managing inventory, accounts receivable, accounts payable, and cash, the company can maintain a healthy cash flow. Example: imagine you have a lemonade stand. Your current assets might include the cash you have, the money customers owe you for lemonade they bought on credit, and the lemons and cups you have in stock inventory. Your current liabilities could be any outstanding bills you need to pay for sugar and other supplies, accounts payable, and the money you owe to your friend for helping you notes payable. If your current assets are more than your current liabilities, you have positive working capital, and your lemonade stand is in good shape. In summary, working capital is a critical measure of a company's short-term financial health. It helps us understand if a business has enough cash and liquid assets to cover its short-term debts. By managing working capital efficiently, companies can ensure they have enough cash flow to sustain their operations and continue to grow. The cash flow statement is like a special report that shows us where the money is coming from and where it's going within a specific period. It's all about tracking the cash movements of a company. Here are the 3 sections of the cash flow statement. Operating activities. Cash flow from operations CFO. Cash flow from financing CFF. Operating activities. Operating activities are the main jobs a business does to create and sell products or services, like making, advertising, and selling things. This is where most of a company's money comes from and tells if it's making a profit. Other activities like selling stocks or buying equipment are different and help the company in the long run. Why is this important? Knowing about operating activities helps people understand how a company is doing. It shows if a company is making money by selling goods or services, not just by one-time things like selling a building. This information helps investors decide if a company is a good place to put their money. Easy example: imagine a bakery. Its operating activities include buying flour and sugar, baking cakes and bread, selling them to customers, and paying workers. If the bakery makes more money from selling cakes and bread than it spends on ingredients and salaries, it's doing well. But if it's only making money by selling off its ovens, that's not a good sign for the future. You can find details about these activities on the company's financial reports, like the cash flow statement. Investors look at this to see if the company is making money in a way that can keep going. Cash flow from operations CFO. This section tells us how much cash the company generated from its main business operations. It includes the cash the company received from selling its products or services, and the cash it paid for operating expenses like salaries, rent, and other day-to-day costs. Why is it important? CFO helps us understand how well the company's core business is generating cash. Positive CFO indicates that the company is making money from its primary operations, which is a good sign of financial health. Example: if you have a lemonade stand, the cash you receive from selling lemonade to customers is a part of CFO. Also, the cash you pay for lemons, sugar, and cups to make the lemonade is included in CFO. Cash flow from financing CFF. This section reveals the cash flow related to financing activities. It includes cash received from borrowing money loans or issuing new shares to investors. It also includes cash paid out as dividends to shareholders or repaying debt. Why is it important? CFF shows how the company is raising money or paying money back to investors and creditors. It's essential for understanding the company's financial structure and how it's managing its debt and equity. Example: if your lemonade stand borrows $100 from a friend to expand the business, the cash received from the loan would be part of CFF. The cash flow statement helps us see how the company is managing its cash. It shows if there's enough cash flow to cover expenses and investments. Financial decision-making. Investors and stakeholders use the cash flow statement to make informed decisions about investing in or lending money to the company. It provides insights into the company's cash position and its ability to fund future operations and growth. In summary, the cash flow statement is a valuable financial statement that shows the ins and outs of cash within a company. It helps us understand the sources and uses of cash, giving us a clearer picture of the company's financial health and how it's managing its cash resources. CFO, which stands for cash flow from operations, is like a financial report that shows us how much actual cash a company makes from its day-to-day operations. It's all about tracking the cash that comes in and goes out from running the business. To understand CFO, we need to know two things. The income statement is like a summary of a company's revenues, money earned, and expenses costs during a specific period. It shows if the company made a profit, positive net income, or had a loss, negative net income. Balance sheet accounts. The balance sheet is like a snapshot of the company's financial position at a specific moment. It lists all the company's assets, things it owns, liabilities, debts, and obligations, and owner's equity, net worth. Now here's how CFO is related to the income statement and some balance sheet accounts revenue. In the income statement, we see the total money the company earned from selling its products or services revenue. This is like the money that comes in from customers. Expenses. The income statement also shows the costs and expenses the company had to pay, like salaries, rent, and other bills. These are the costs of running the business. Accounts receivable. When the company sells products or services on credit, customers buy now and pay later. It records the money it's owed as accounts receivable. This is money that should come in later as cash. Inventory. Inventory is the stuff the company has in stock to sell to customers. It's like the value of the products ready to be sold. Accounts payable. Accounts payable is the money the company owes to suppliers or vendors for goods or services it received but hasn't paid yet. Accruals. Accruals are expenses that the company has incurred but hasn't paid yet, like employee salaries or taxes. Real cash generation. CFO shows us the actual cash the company is making from its everyday operations. It's different from just looking at the profit on the income statement because profit includes non-cash items like depreciation. CFO focuses on the cash that's really coming in and going out. Cash management. By tracking CFO, we can see how well the company is managing its cash flow from its main operations. Positive CFO means the company is making money from its core business, which is a good sign of financial health. Sustainable operations. Positive CFO indicates that the company is generating enough cash to support its ongoing operations and pay its bills. Your revenue is the money you made from selling lemonade to customers. The expenses are the costs of lemons, sugar, and cups to make the lemonade, as well as other expenses like rent and your friend's salary who helps you. If you sold lemonade to some customers on credit, the money owed to you is accounts receivable. And the lemons, sugar, and cups you have in stock are your inventory. CFO would add up all the cash you received from selling lemonade, minus the cash you spent on expenses like lemons and cups, and it would also consider the money you collected later from customers who bought on credit. It gives you the real cash you made from your lemonade stand's operations. In summary, cash flow from operations CFO is an essential part of the cash flow statement. It focuses on the real cash generated from the company's primary business activities. By tracking CFO, we can understand how well the company is doing in terms of generating cash from its daily operations, which is crucial for its financial stability and growth. Cash flow from investing CFI is like a section of the cash flow statement that tells us about the money the company has invested in its business and other assets during a specific period. It also includes any investments the company has made in other companies or financial instruments like stocks and bonds. Here are the two main components of CFI. Capital expenditures CapEx. This refers to the money the company spends on buying long-term assets like equipment, machinery, buildings, or vehicles. These assets are essential for the company's operations and help it produce goods or provide services. Investments. This includes any cash spent on buying stocks, bonds, or other financial instruments issued by other companies or entities. It also includes any cash received from selling these investments. Now, let's see why CFI is important. Growth and expansion. CFI shows us how much money the company is investing in its own growth and expansion. If a company is spending a lot on new equipment or facilities, it could be a sign that it's planning to grow its operations. Capital allocation. CFI reveals how the company is allocating its capital money. By investing in productive assets or profitable investments, the company aims to generate more income and enhance shareholder value. Future prospects. CFI helps us understand the company's long-term plans and its commitment to investing in its future success. Imagine you have a lemonade stand and you decide to invest in a new lemon squeezer machine to make lemonade faster. The money you spend on buying that machine would be part of CFI. Also, if you buy some shares of a lemonade equipment company, that investment would also be part of CFI. In summary, cash flow from investing CFI is an essential part of the cash flow statement that tells us about the company's investments in its own growth and other assets. By tracking CFI, we can gain insights into the company's plans for expansion, its capital allocation strategies, and its commitment to building a stronger and more profitable business for the future. Cash flow from financing CFF. Cash flow statement that shows us how the company has raised or used cash from various financing activities during a specific period. It focuses on the cash flow related to the company's financial structure and how it has obtained or repaid money from different sources. Here are the main components of CFF. Issuing or selling stock. When a company needs money, it can sell shares of its ownership stock to the public or investors. The cash it receives from selling these shares is considered a positive inflow in CFF. Borrowing money. Sometimes companies need more cash than they currently have, so they borrow money from banks or other lenders. The cash received from these loans is also considered a positive inflow in CFF. Repaying debt. If a company pays back the money it borrowed, it's considered a negative outflow in CFF. It's like reducing the company's financial obligations. Dividends. If the company pays dividends to its shareholders, the people who own the stock, it's considered a negative outflow in CFF. Dividends are a way of capital funding. CFF shows us how the company is getting the money it needs to finance its operations and growth. Positive CFF means the company is raising cash from external sources to support its activities. Debt management. By tracking CFF, we can understand how the company is managing its debt. If a company is borrowing a lot, it can indicate that it might have higher interest payments in the future. Dividend policy CFF helps us see if the company is paying dividends to its shareholders. If dividends are increasing, it could be a good sign of a company's financial health and success. Imagine you have a lemonade stand, and you need money to buy more lemons and cups. You decide to sell some ownership stock of your lemonade stand to your friends. The money you receive from selling the stock would be a positive inflow in CFF. Now, let's say you borrowed $50 from your parents to expand the business. The money you received from the loan would also be a positive inflow in CFF. If you later decide to pay back the $50 to your parents, it would be a negative outflow in CFF. And if you decide to share some of your profits with your friends as a thank you for investing in your lemonade stand, the money you pay them would be a negative outflow in CFF. In summary, cash flow from financing CFF is an essential part of the cash flow statement that shows us how the company is raising or using cash from financing activities. By tracking CFF, we can better understand the company's financial decisions, capital funding strategies, and how it manages its debt and shareholder payments. It's like a special report that explains the changes in the owner's equity section of the balance sheet over a specific period. It shows how the owner's investment in the company, their ownership stake, has changed due to various transactions. Here are the main items you typically see on the statement of owner's equity: net income. This is the profit the company earned during the period, as calculated in the income statement. It represents the money left over after deducting all expenses from the revenue. Net income is like the company's bottom line, or profit. Dividends paid. If the company distributes a portion of its profits to its shareholders, the owners, as dividends, it will be recorded here. Dividends are like thank you payments to shareholders for investing in the company. Stock issuance or redemption. If the company sells new shares of stock to investors, or buys back, redeems existing shares from shareholders, it will be shown here. Issuing stock raises money for the company, while redeeming stock reduces the number of outstanding shares. Other items affecting equity. This category includes any other transactions or events that impact the owner's equity but are not related to net income, dividends, or stock issuance/redemption. Now, let's see why the statement of owner's equity is important. Owner's investment changes. This statement shows how the owner's equity in the company has changed during the period due to various activities. It helps the owners and investors understand how their investment is growing or shrinking. Assessing financial health. By analyzing the statement of owner's equity, stakeholders can see if the company is profitable, positive net income, and whether it's returning value to its shareholders through dividends. Decision-making. The statement provides valuable information for owners, investors, and management to make informed decisions about the company's financial structure and distribution of profits. Example: imagine you have a lemonade stand. At the beginning of the year, you invested $100 of your own money as the owner's equity to start the business. During the year, you made a profit of $50 from selling lemonade net income. If you decide to take $20 from the profit and give it to yourself as a thank you for running the lemonade stand, dividends paid, the statement of owner's equity would show the $20 decrease in your equity. Additionally, if you decide to sell 10% of your lemonade stand to a friend for $15 stock issuance, the statement would show a $15 increase in your equity. In summary, the statement of owner's equity is an important financial statement that explains the changes in the owner's investment in the company over time. It provides valuable insights into the company's profitability, distribution of profits to owners, and any changes in its capital structure. Financial statements are official reports that show a company's financial activities. They are prepared to inform investors, management, and tax officials about the company's money matters. These statements usually consist of four main parts: the balance sheet, income statement, cash flow statement, and statement of changes in equity. The balance sheet provides a snapshot of what the company owns: assets, what it owes, liabilities, and what's left for the owner's equity at a specific moment in time. It's like taking a picture of the company's financial condition. The income statement shows the company's expenses and profits over a period of time, letting us know if the company made money or lost money during that time. The cash flow statement tracks the flow of cash in and out of the business, showing how much money comes in from operations, investments, and financing. The statement of changes in equity explains how the company's ownership changed during the reporting period, including factors like profits or losses, dividends paid, and any changes in the company's stock. Financial statements are official reports. These financial statements are essential tools for understanding a company's financial health and how it manages its money. They help to keep finances organized and are presented in a structured way following accepted accounting standards. In more complex cases, additional notes may be included to explain specific financial figures or accounting methods used in preparing the statements. Explanation in simple terms. Financial statements are like reports that show how a company is doing financially. They communicate important financial information to different parties, like investors, managers, and tax officials. There are four main parts of a financial statement. The balance sheet. It's like taking a picture of what the company owes, and what's left for the owners at a specific time. The income statement. It shows if the company made a profit or had a loss over a period of time. The cash flow statement. It tracks the money flowing in and out of the company. The statement of changes in equity. It explains how the ownership of the company changed during the reporting period. Mental models and analogies. Think of financial statements as a financial health report for a company. It's like a health checkup that helps you understand if the company is doing well financially or needs some improvement. Imagine the balance sheet as a snapshot taken to capture what the company owns and owes at a particular moment, like a selfie that freezes a moment in time. Example exercises and answers. What are the main components of a financial statement? The main components are the balance sheet, income statement, cash flow statement, and statement of changes in equity. How is the income statement different from the balance sheet? The income statement shows if the company made a profit or had a loss over a period of time, while the balance sheet provides a snapshot of the company's assets, liabilities, and equity at a specific moment. What does the cash flow statement track? The cash flow statement tracks the money coming in and going out of the company. Advantages and disadvantages. Advantages. Financial statements help investors and managers make informed decisions about the company's financial health. They provide transparency and accountability to stakeholders. Financial statements are essential for complying with tax and regulatory requirements. Disadvantages. Financial statements may not capture all aspects of a company's performance, especially qualitative factors. Preparing financial statements can be time-consuming and may require expertise in accounting. Importance. Understanding financial statements allows you to assess a company's profitability, liquidity, and overall financial health. It helps in making smart investment decisions and evaluating potential risks. Financial statements are crucial for businesses to plan and strategize effectively. Knowing how to read and interpret financial statements is vital for making informed financial decisions, whether you are an investor, manager, or entrepreneur. It gives you valuable insights into a company's financial situation, allowing you to identify strengths and weaknesses and make better financial choices. Purpose of financial statements. Financial statements are official reports that show how a company manages its money. They communicate this information to investors, managers, and tax officials. Components of financial statements. There are four main parts of financial statements: the balance sheet, income statement, cash flow statement, and statement of changes in equity. Balance sheet. This is like a photo that captures what the company owns assets, owes liabilities, and what's left for the owner's equity at a specific time. Income statement. It's like a movie that tells us if the company made a profit or had a loss over a period of time. Cash flow statement. This is like a map that tracks the money coming in and going out of the business. Statement of changes in equity. It's like a journal that explains how the ownership of the company changed during the reporting period. Purpose of financial statements. Expenses. These are the costs the company incurs to earn revenue, like buying materials or paying employees. Liabilities. These are the obligations or debts the company owes due to past transactions or borrowing money. Equity. This represents the interest that investors have in the company's assets after all debts are paid. If debts are more than assets, negative equity can be resolved by selling stocks. Importance of financial statements. Financial statements help us understand a company's financial health, make informed investment decisions, and ensure compliance with financial regulations. Example exercise. Question. What is the main purpose of the balance sheet? The main purpose of the balance sheet is to show a snapshot of what the company owns, owes, and what's left for the owners at a specific time. By understanding these key points, you'll have a solid foundation to comprehend financial statements and their significance in evaluating a company's financial position and performance. Financial statements purpose. Financial statements are formal documents that communicate a company's financial activities to various parties, including investors, management, and tax officials. Components. A standard financial statement typically includes four main parts: the balance sheet, income statement, cash flow statement, and statement of changes in equity. Balance sheet snapshot. The balance sheet provides a snapshot of a company's assets, liabilities, and equity at a specific moment in time. It shows what the company owns, what it owes, and the residual value for owners. Income statement performance. The income statement shows a company's performance over a specific period, revealing its expenses and profits. It tells us if the company made money profit or lost money loss. Cash flow statement. The cash flow statement tracks the flow of cash in and out of the business. It divides cash into three categories: operating daily business activities, investing buying/selling assets, and financing borrowing and repaying money. Statement of changes in equity. This statement explains how the company's ownership equity changed during the reporting period. It includes factors like profits or losses, dividends paid, and the issuance or redemption of stock. Key terms. Understand key terms like expenses, cost of assets/services used to earn revenue, liabilities, obligations arising from past events, equity, investors' interest after liabilities, and assets, economic resources that produce future benefits. Financial statement. A financial statement is a formal report summarizing a business's financial activities. It's a key component of accounting and helps communicate financial information to stakeholders' balance sheet description. Think of the balance sheet like a photo album capturing a company's financial memories at a specific time, showcasing what it owns and owes. Cash flow statement analogy. Picture the cash flow statement as a map of money highways, showing where money comes from income and where it goes expenses, investments, or financing. Understanding financial statements is crucial because they provide insights into a company's financial health, allowing you to assess its profitability, liquidity, and overall performance. Investors use financial statements to make informed decisions, and management relies on them for strategic planning. They are essential for regulatory compliance and understanding a company's short-term and long-term viability. Financial statements are like report cards for businesses. They show how well a company is doing financially and what it owns and owes. These statements are essential because they help people make important decisions about the company. Example: the owners and managers of the company use these statements to decide if they should keep or stop certain parts of the business, whether to buy materials or make them themselves, and whether to rent or buy equipment for making their products. Investors use financial statements to figure out if it's a good idea to invest their money in the company. Lending institutions look at these statements to decide if they should give a loan to the company. Besides that, financial statements can also be used as a budgeting tool to plan how the company will spend its money in the future. Different people and organizations, like charities, government tax authorities, vendors, and employees, also use financial statements for various purposes, such as determining where to donate money, checking tax payments, assessing creditworthiness, and negotiating contracts with workers. In a nutshell, financial statements are vital tools that help everyone understand how well a business is doing and guide important choices. They need to be easy to read and understand since so many people rely on them to make decisions. Financial statements are like report cards for businesses. They show how well a company is doing financially and what it owns and owes. These statements help people make important decisions about the company. Mental model, building blocks. Think of financial statements as 3 building blocks. Income statement. This shows how much money the company made and spent over a period like a year. It tells you if the company made a profit or loss. Balance sheet. This lists everything the company owns, assets, and everything it owes, liabilities. It gives you an overall picture of the company's financial health. Cash flow statement. This tracks the money coming in and going out of the company. It helps you understand if the company has enough cash to pay its bills. Example exercise. Let's practice with a simple question. Why would a lending institution look at a company's financial statement before deciding to give them a loan? A lending institution wants to make sure the company can pay back the loan. They look at the financial statement to see if the company is financially healthy and able to handle the loan payments. Advantages and disadvantages. Advantages of financial statements. Helps owners and managers make important decisions about the business. Assists prospective investors in deciding whether to invest in the company. Enables lending institutions to assess the financial health and creditworthiness of the company. Useful for planning and budgeting purposes. Disadvantages of financial statements. For large corporations, financial statements can be complex and may require some expertise to understand fully. Financial statements may not capture every detail or future changes in the business environment. In some cases, companies may try to manipulate financial statements to present a better picture of their financial health. Why it's important to know. Understanding financial statements is crucial because they provide valuable information about a company's financial performance and help in making informed decisions. Whether you're an owner, investor, lender, or employee, knowing how to read and interpret financial statements empowers you to assess the health of a business and make wise choices. Remember, just like learning anything new, practice and patience are key. Start with simple concepts and gradually build your understanding. The more you familiarize yourself with financial statements, the better equipped you'll be to make informed decisions in the business world. Key points. Financial statements are like report cards for businesses. They provide essential information about how well a company is doing financially and what it owns and owes. Types of financial statements. There are 3 main types of financial statements. Income statement. Shows the company's revenue, income, and expenses to calculate profit or loss. Balance sheet. Lists the company's assets, what it owns, and liabilities, what it owes to determine its overall financial position. Cash flow statement. Tracks the money coming in and going out of the company to assess its cash flow. Importance of financial analysis. Financial analysis is the process of examining financial statements to assess the company's viability, stability, and profitability. It helps in making informed decisions about the business. Users of financial statements. Various people and organizations use financial statements for different purposes, such as owners, managers, investors, lenders, philanthropies, government tax authorities, vendors, and employees. Long-term business decisions. Owners and managers use financial statements to make significant long-term decisions, like whether to continue or stop certain parts of the business, what materials to make or purchase, and whether to rent or buy equipment for production. Investment decisions. Prospective investors analyze financial statements to decide whether investing in a company is a good idea. They want to see if the company is financially healthy and likely to provide a good return on their investment. Lending and credit decisions. Lending institutions and vendors check financial statements to determine the creditworthiness of a company. They want to know if the company can repay loans and debts on time. Budgeting tool. Financial statements can be used as a budgeting tool. They help in planning and managing the company's finances for the future. Role of notes in financial statements. Financial statements may have detailed notes that explain each item in the statements. These notes are crucial to fully understand the company's financial position and policies. Historical records and source of information. Financial statements are valuable historical records that show the company's financial performance over time. They serve as a reliable source of information for decision-making and comparison. Understanding financial statements is essential for anyone involved in the business world, as they provide vital insights into a company's financial health and guide critical decisions. Whether you're an owner, investor, lender, or employee, being familiar with financial statements empowers you to make informed choices and contribute to the success of the company. All right, imagine you're running a business you want to know how well it's doing financially. That's where the income statement comes in. It's like a report card for your business's money situation over a specific period of time, like a month or a year. The income statement has a few important parts. First, it shows how much money you made from selling your products or services, and that's called revenue. Then, it lists all the expenses you had during that time, like the cost of making or buying the things you sell, paying employees, rent, and other stuff like that. After adding up all the revenue and subtracting all the expenses, you get what's called the net income. This is like the final score after taking everything into account. If the net income is positive, that means your business made a profit. But if it's negative, then there was a loss. The income statement helps investors and managers see if the business is making money or not. It's a way to understand how well the company is doing financially. For example, if the net income is high, that's a good sign because it means the business is making more money than it's spending. The income statement has two main sections, the operating section and the non-operating section. The operating section includes revenue and expenses directly related to the main business activities. The non-operating section includes things like income from other sources that are not the primary business activities and expenses that are not directly related to the main business. The bottom line of the income statement is the net income. It's the final number that shows whether the business made a profit or not. This number is crucial for investors because it tells them how much profit the company made during that period. And it's also used to calculate earnings per share, which is another important thing investors look at. So the income statement is like a report that tells you if your business is making money or not. It helps you see the big picture of your company's financial health over a specific time, and it's essential for investors to know how well the business is doing. The income statement is like a report card for a company's finances. It shows how much money the company made revenue and how much it spent expenses over a period of time, like a month or a year. After subtracting expenses from revenue, you get the net income, which tells if the company made a profit or had a loss. Mental models and analogies. Think of the income statement as a recipe for a cake. The revenue is all the ingredients you put in, and the expenses are the costs of those ingredients. The net income is like the delicious cake you get at the end. If the cake costs less to make than what you can sell it for, you make a profit. But if it costs more, you end up with a loss. Picture the income statement as a funnel. At the top, you pour in all the revenue streams, money coming in. Then as it goes down the funnel, you deduct various expenses, like the cost of goods sold and operating expenses, until you reach the bottom, which is the net income. Example exercises. Let's practice calculating net income. Imagine a company had total revenue of $10,000 in a month. The cost of goods sold was $3,000, and operating expenses were $2,500. Calculate the net income. Net income equals revenue, cost of goods sold, Operating expenses net income equals $10,000, $3,000, $2,500 equals $4,500 now. Let's find the net income per share. Suppose the company has 1,000 shares outstanding. Calculate the earnings per share EPS using the net income from the previous exercise. EPS equals net income / number of shares outstanding. EPS equals $4,500 / 1,000 equals $4.50 per share. Advantages and disadvantages. Knowing about the income statement is essential because it helps investors and managers understand if the company is making a profit or loss. It shows how well the company performed over a specific period, which helps predict future performance. The income statement's bottom line net income is crucial for investors as it represents the profit that shareholders can receive. It is a vital financial statement that provides insight into a company's financial health. However, it's important to keep in mind that the income statement has limitations. It only shows the financial performance over a specific period and doesn't give a complete picture of the company's overall financial health. It may not reflect non-cash transactions or long-term investments that affect the company's value. Companies can sometimes manipulate the income statement to make their financial performance look better than it actually is. Understanding the income statement helps you evaluate a company's financial performance, make informed investment decisions, and assess its ability to generate future cash flows. It's a fundamental tool for anyone involved in finance, accounting, or investing. Key points I should know. The income statement is a financial statement that shows how much money a company made and spent over a period of time. Components. It consists of revenues, money earned, and expenses, money spent during that time. Net income. The bottom line of the income statement is the net income, which is calculated by subtracting expenses from revenue. Profit or loss. If net income is positive, it means the company made a profit. If it's negative, there was a loss. Time period. The income statement covers a specific period, like a month, quarter, or year, to show the company's financial performance. Importance to investors. Operating versus non-operating. The statement is divided into the importance to investors. Operating section main business activities and non-operating section other activities affecting income. Investors use the income statement to see if the company is making money and to assess its financial health. Earnings per share EPS. EPS shows how much profit a shareholder would get for each share they own. Gross profit is revenue minus the cost of goods sold. It shows how much money is left after selling products. Single versus multi-step. There are two methods to prepare the income statement. Single-step revenues minus all expenses and multi-step several intermediate steps. Importance of understanding the income statement. Helps investors make informed decisions about investing in a company. Assists managers in evaluating the company's financial performance and making strategic decisions. Gives insight into a company's ability to generate future cash flows and predict future profitability. Provides a snapshot of the company's financial health over a specific period. Enables comparison of performance with previous periods or other companies in the same industry. Knowing the income statement is crucial for anyone involved in finance, accounting, or investing, as it provides essential information about a company's profitability and financial stability. GAAP, generally accepted accounting principles, is a set of rules and guidelines that companies use to prepare their financial statements in a standardized and consistent way. These principles affect how a company's income statement is created and what information is included. One of the main impacts of GAAP on income statements is the concept of temporary differences and permanent differences. Temporary differences occur when the timing of recording transactions for financial accounting differs from the timing required for tax accounting. For example, when a company receives rent or revenue in advance, it creates a temporary difference because the income is recorded now for accounting purposes, but it may be taxed later when the cash is received. On the other hand, permanent differences arise from events that affect the income statement differently for financial accounting than for tax accounting. For instance, an expense recognized by GAAP might not be allowed as a deduction by the IRS for tax purposes, leading to a permanent difference in the reported income. GAAP is based on 4 key principles that guide how transactions are recorded. Historical cost principle. This principle requires companies to record their assets and liabilities based on their original acquisition costs, rather than their current market values. Revenue recognition principle. Companies must record revenue when it is earned and realized, not necessarily when the cash is received. This ensures that revenue is matched with the appropriate period of its generation. Matching principle. Expenses are recorded when they are incurred and matched against the related revenue. It's not necessarily when cash is paid out. This helps in presenting an accurate picture of profitability in a specific period. Full disclosure principle. Companies should provide all relevant information in their financial statements, ensuring transparency and helping stakeholders make informed decisions. To summarize, GAAP is a set of accounting rules used by companies to create consistent and reliable financial statements. It includes principles that dictate how assets, liabilities, revenue, and expenses are recorded. By following these principles, companies aim to provide a clear and accurate picture of their financial performance. GAAP generally accepted accounting principles is like a set of rules that companies follow to create their financial statements in a standard and consistent way. These rules help ensure that financial information is accurate and comparable, making it easier for investors, lenders, and others to understand a company's financial health. Mental model. Think of GAAP as a recipe book for cooking financial statements. Just like a recipe helps you make a delicious dish by following step-by-step instructions, GAAP guides companies on how to prepare their financial reports correctly. Temporary differences versus permanent differences. Imagine you have two watches, one showing the actual time and the other showing the time you wish it was. The actual time watch represents the financial accounting under GAAP, while the wishful time watch represents the tax accounting under IRS rules. Sometimes the two watches show the same time temporary differences, and sometimes they show different times permanent differences. The four basic principles of GAAP. Let's use a cooking analogy to remember the principles. Historical cost principle. Just like a recipe card shows the original list of ingredients and their prices, GAAP wants companies to use the original cost of assets and liabilities in their financial statements. Revenue recognition principle. Think of a bakery that records the sales when customers order and pay for cakes, not when they take the cakes home. Similarly, GAAP tells companies to record revenue when it's earned, not just when they receive the cash. Matching principle. Picture a dance where partners take turns. In accounting, expenses take turns with revenues. GAAP advises companies to match expenses to the revenue they help generate, even if the actual payment happens later. Full disclosure principle. Imagine you're selling a car. Before the buyer decides, you give them all the information about the car's condition. Similarly, GAAP says companies should provide all relevant financial information to stakeholders so they can make informed decisions. Example exercises. What are the two types of differences that can affect income statements due to GAAP? Temporary differences and permanent differences. Give an example of a temporary difference. Recording rent revenue collected in advance. The income is recorded now, but the tax may be paid later when the cash is received. What are the four basic principles of GAAP? Historical cost principle, revenue recognition principle, matching principle, and full disclosure principle. Advantage and disadvantages of GAAP. Advantage GAAP. Companies disclose relevant information, promoting transparency and trust. Accurate decision-making. GAAP helps investors and creditors make informed decisions based on reliable financial data. Consistency. GAAP helps companies present their financial information in a uniform manner. Transparency. It ensures that relevant information is disclosed, making it easier to understand a company's financial health. Comparability. GAAP allows for easy comparison of financial statements across different companies and industries. Credibility. Following GAAP increases the trust and confidence of investors and creditors in a company's financial data. Disadvantages of GAAP. Complexity. GAAP can be complex, and companies may need accounting experts to interpret and apply the rules correctly. Rigidity. GAAP might not adapt quickly to changes in the business environment, making it less flexible in certain situations. Some critics argue that GAAP can be too rigid and not adaptable to certain unique. Why is this important to know? Understanding GAAP is crucial because it ensures that companies present their financial information consistently and accurately. This is essential for investors, creditors, and other stakeholders who rely on financial statements to assess a company's performance and make informed decisions. Moreover, adhering to GAAP helps maintain the integrity and credibility of financial reporting in the business world. GAAP and its principles is crucial for anyone involved in finance, accounting, or business. It helps maintain consistency and transparency in financial reporting, which is essential for making informed decisions about investments, loans, and business performance. Key points I should know about this section. GAAP definition. GAAP stands for Generally Accepted Accounting Principles. It's like a set of rules and guidelines that companies follow to create consistent and reliable financial statements. Temporary versus permanent differences. GAAP can cause differences in income statements. Temporary differences occur due to timing discrepancies between financial accounting and tax accounting, while permanent differences arise from events that affect income differently under GAAP and IRS rules. Examples of temporary differences: things like collecting rent in advance, estimating expenses, and deferred tax assets and liabilities can create temporary differences in accounting. Examples of permanent differences: some one-time events such as GAAP recognizing an expense that the IRS doesn't allow as a deduction can create permanent differences in income reporting. The four basic principles of GAAP. Historical cost principle. Record assets and liabilities based on their original acquisition costs, not their current market values. Revenue recognition principle. Record revenue when it's earned and realized, not just when cash is received. Matching principle. Match expenses with the related revenues they help generate, even if cash payment occurs later. Full disclosure principle. Provide all relevant financial information in the statements, ensuring transparency. Key terms: deferred. This term means a value that will be realized or recognized in the future. For example, deferred taxes refer to taxes that will be paid or received in the future. Fair market value. It's an estimate of the market value of a property or asset, based on what a knowledgeable and willing buyer would probably pay to a knowledgeable and willing seller. Matching principle explained. Expenses are recognized when obligations arise, like when goods are sold, and they are matched against the recognized revenues generated by those expenses, regardless of when cash is paid out. Timing differences explained. The differences between financial accounting GAAP and tax accounting IRS rules can create timing differences in income reporting. Importance of full disclosure. The full disclosure principle ensures that companies provide enough information to stakeholders so they can make well-informed decisions. Objective, material, consistent, and conservative reporting. GAAP suggests that income statements should present financial figures that are unbiased, significant, reliable, and cautious. GAAP versus IRS regulations. GAAP focuses on matching principles and accruals for financial accounting, while IRS tax regulations are more oriented toward cash transactions for tax accounting.